Welcome to the Master's Certificate in Technical Analysis, Module 13. And in Module 13 we're talking about the stock market. Now we've gone through most of the indicators and the technical analysis items in the previous modules. We're now looking at 8 particular indicators that we use in different markets and what things we can pick out from trading in the different markets. We're starting in the stock market, and we'll go on to discuss the derivatives in further modules. So in the stock market we look at relationships between shares, between various things indeed. We look at the relationship between the strength of the dollar and how the stock market is doing. And if the dollar is strong, we find that large companies tend to do well, because large companies, they're the ones that tend to have the bigger market, have more export market, so if the dollar is strong, it's not selling so much. So that's one of the relationships you can find when you think about it, or when you look at it that way, the prices perform. And again, if energy is going upwards, it's expensive, then that's obvious that now it's likely to hit the airline stocks. They suffer because airlines have to buy fuel for their aircraft, and one exception for that is, I think, Southwest. Southwest is clever enough, I think, because they buy fuel for many years ahead, usually at a very cheap price, so they don't suffer straight away if the price goes up. Most of the airlines, their shares tend to suffer when the price of oil goes up. So there are various ways you can look at relationships and see the fields that you think will be strong. Now bear in mind that what we're doing is trading is that most of the time we're looking for a strong trend. Usually what we think could be an uptrend or could be a downtrend, as well as one that's very short. But let's just confine it to an uptrend. We're looking for a stock that's going to trend up strongly. You're looking for the best of the best, and you're looking for the best stock. There's no reason to trade anything else if you have a trend trading plan. The way you find that is by something called relative strength analysis, not to be confused with the relative strength indicator, which is just on one stock. The relative strength analysis looks at the strengths between different stocks or different sectors, and we can look at the relative strength between the two by dividing one with the other and see which one is the strongest. In a way, we're now down to the stocks that we're able to look at if we're looking for uptrend stocks. We'll look first at the sectors. Maybe we'll look at healthcare, and maybe we'll compare healthcare with the energy sector. Which one is doing well now in this time of year? Is it the healthcare or is it the energy sector? We find a strong sector, and then we look within that sector and say, what is strong within that sector? For example, if it is energy, we might say, well, is it oil or is it gas? Which one of those is performing well in this strong sector? So you'll do a relative strength analysis between oil and gas within that strong sector and say, yeah, looks like gas has started to perform well. So therefore you narrow it down to gas. And then you look at the company which are in the gas business, and you do a relative strength analysis between those, and you come up with the best performing within that. So that's what I mean by looking for the best of the best. You're not necessarily getting the best of the 5,000 stocks, but you're certainly getting a very good stock narrowed down by that process. It's much quicker than comparing, say, 5,000 stocks to each other. So that's one way we can look for the stocks we're trading, and that's called the top-down way. We started at the top. We started by looking at the big chunks of the sectors, and then we went down to the shares. So that's one way to look at the market and see where we might be able to do. But another way is to look at the market breadth. Market breadth basically says how strong is a market, or how strong a section of it is. We'll have various indicators of that. This is a screenshot from the internet. You can see firstly advances and declines. That's the numbers of shares that closed higher than they opened in advances, and the ones that closed lower, they opened as declines. In this case, the New York Stock Exchange, the advancing issues were more than 2,000 on this particular day, and declining issues were somewhere around 500. So much less declining issues, so therefore it's a bull market. There's a few unchanged issues as well. And we can further see it's a bullish market when we see new highs at 646 and new lows only 10, so only 10 shares fared lower than they started the day. I guess I would be happy with that. Now if you look at the left, there's also some other things you can look at. The volume leaders. Heavy volume means that there's a lot of interest that might be an interesting thing to look at. Price percent gains and price percent losses, so you can see which one has gained the most investors, and even got a section of unusual for you, rising, falling, which indicators that something might be happening. You might be able to take a look and say, why is there more fall in this particular day than any other days? That is something we want to know about when we trade. So there's various ways of looking at it. You can see that the volume of trading up a billion is over 3 billion, and down volume is about 2 billion, and that's just in the New York Stock Exchange. So again, the up volume is the volume traded on the shares that were up, and again the volume is telling us that this was a bullish day. Again, there were new highs and new lows. It looks like a very bullish day. So that's just some of the things and some of the indicators that we can look at to see. Basically, we look at the indicators to see how they're performing and what the health of the market is. First one we'll look at is advancing issues versus declining issues. You can look at this indicator in several ways. Obviously, if advancing issues are more than declining issues, then you're looking at a bull market. So that's the fundamental, but you can look at these numbers in different ways. You can produce a chart of the advancing issues than there were the declining, and you can do a cumulative advancing declining chart, which is where you add on each day's numbers to the running total that can give you some of the indication. And also you can just divide advancing issues by declining issues and getting a number by that. Obviously, if you've got a lot of advancing issues and a small number of declining, then the number becomes quite large. And if you have a lot of declining issues, it's a bear market, then you'll be down by 1. And your chances are you'll go down to 0. If you do the dividing, you'll probably find it's too jagged to interpret, and what you can do is just smooth it out by doing, say, 10-day similar moving average. So many of these indicators work better if they're smoothed out that way. Next one to talk about is the McClellan oscillator. This is simply taking the advantage declining indicator, and it plots the difference between the exponential moving average for 19 days and the exponential moving average for 39 days, and that smooths it out as well. That then goes from minus 100 to plus 100, and basically if a number goes as far as 100 or even close to it, you're looking to see whether the market is overbought or oversold. And some traders also take it being close to 0 to be an indication to buy. So the McClellan oscillator, we can also get McClellan's summation index. This is simply adding up the value of the McClellan oscillator day after day. Again, this is just cumulative. So you add up the index for today to the index as it was yesterday. Again, it's just culminates on. And obviously, because you're doing that, the total doesn't mean a lot because it depends where you started counting, but it tells you whether it's going up or down. You tend to use the McClellan index just to look at the longer term trends, and the McClellan oscillator is better for the shorter term trends. Next thing you can look at, as we saw on the printed out chart, is new highs and lows. That's the stocks making new highs or making new lows, and usually this is over 52 weeks. So the number of new highs is on those who achieved the highest price in the last 52 weeks of trading. Again, if you have a lot of new highs, as you see in the chart, not as many new lows, then that means that the stock on the whole is bullish and booming. So that's another way of looking at it, the way the shares have been behaving. And again, new highs and new lows, you have choices. It may be dependent on your charting software, but you have choices. New highs minus new lows may be plotted, so therefore if you have more highs, this will be positive. If you have more lows, this will be negative. You can do it cumulative again. where you keep adding each day to the previous day's number, and you can also do dividing highs by lows, and they'll give you different types of shapes on charts or different types of indicators. But what we're looking for now is how they'll give us some confirmation of a bullish trend, but also we are looking for divergence. Because if it's going the other way from moving averages, then you'll say maybe something is happening here, and there may be a turning point coming up the market. So if you're looking for a divergence, I think I approached this in the earlier modules for the Dow Jones Industrial Average, and that was in the US factories. So we're comparing it like with like, and if we're getting a divergence from the details, then we know that maybe something is happening, maybe the trend is coming to an end. The other thing we emphasize the importance of in the earlier modules is trading volume. If volume doesn't match or does that confirm or deny how the market is going, and again we get a trading volume that can be the volume of the advancing issues against declining issues. Stocks that closed higher than they were opened are advancing issues, and we'll see how much trade volume there was, and those are the ones closed lower, those are declining volume there again, and you can verify and see what you want to do. But there is also an indicator. This is called the Richard Arms invented this indicator, and it was called the Arms indicator for a time. It is now called the TRIN, which is short for Traders Index. And this one combines the number of advancing and declining issues. It's the volume of the advancing and declining issues, really effectively saying that it is saying what's the average trade size for the advancing issues and the average trade size for declining issues. And obviously you can see that if the trade size is bigger for the advancing issues, then obviously that's a good bullish sign. What actually happens when it's calculated, it is a contrary indicator. So if it goes down, that's a good thing, and if it goes up, that's a bearish sign. So if it goes down below volume of one, then that's a good signal, and this one again is better if you get it smoothed out. Richard Arms himself said that this is best used as an extreme indicator, so when the indicator goes to the extreme, then you're looking for an overbought or oversold condition. Richard Arms, I think it was 1983, invented the equivolume chart. If you look at the further charting modules, the candle volume charts, the equivolume is similar. It was invented before it was discovered in the West. The equivolume chart has a rectangle for each day, for each period, and for the width of the rectangle is proportional to the volume traded, and the length of the rectangle is the whole range of trading from the lowest to the highest prices traded that day. So if you've got fat rectangles, then there was a lot of trading volume. But if you have thin rectangles, then the volume was not so much. And if you've got long, high rectangles, there's a bit of range of prices, and with short rectangles, there's a short range of prices. So Richard Arms invented this in 1983, and then Morris, who was one of the people who got onto candlestick charting soon after Steve Neeson, brought it to the Western world. He actually took the idea of equivolume and he applied it to candles and produced the candle volume chart. Candle volume, same idea, the width of the rectangle in proportion to volume, and the height of the rectangle in candles is opening and closing prices, and you have wicks that go to the extremes. Even though it is a very similar chart, it gives you a little bit more information than the equivolume chart. Morris used to call it a candle power chart, but that name, candle volume chart, is more used and is a little bit more descriptive. The top chart is just a regular candle chart, and the bottom one is a candle volume chart. You can see that some of those candles are actually much wider than the others, and this is actually not how it's supposed to be. This is a Dow Jones Industrial Average, and normally when you have an uptrend and advancing price, normally you look for the volume to be more and the candles to be thicker. If it's an uptrend and you've just got a retracement coming on down, then normally those are the thick rectangles. But this doesn't show that. This shows that the thick blue rectangles coming down, that's a downtrend retracement in an uptrending industrial average. And so that actually points to the uptrend being a little bit tenuous, which is all it is saying about this is nothing much to support. the Dow recovery as it is without getting into political things, like we have 10% unemployment, we have all sorts of bad things happening, we have inflation, but we don't really have, but the Dow is going up. And this really is seeing the uptrend having such thin candles. Having such little volume does really cast the question of how solid the uptrend is, but we can see where it goes. The other thing we can do is see the liquidity or the strength of the market is comparing the averages. There are a few in the US and a few in England as well. Ones in the US are quite a variety. The Dow Jones Industrial Average is based on 30 shares weighted over weighted. It went up to 30 shares, then it depreciated and started about 18 back at the end of the 19th century. The S&P is based on 500 shares, the Russell's 2000 shares. The NYSE Composite Index is based on all the shares in the New York Stock Exchange, which is 1,000, and Nasdaq is based on thousands as well, but it's weighted index. Nasdaq is basically looked at as a technology market. What we do with these is look at them and compare them with each other and see if the Dow Jones Industrial Average is going up. Is the S&P going up? Is the Nasdaq going up? Is this a real uptrend or recovery in the economy, or is there something false going on? So this is basically a measurement in market or whether the whole thing is sound. In this case, let's see. The S&P 500 is in the red and the black line, and the Nasdaq is the green. And this is just as simple. The way you can do is one is divided by the other, and this is relative strength exercise, but if you looked at it, it's very close and the dips and the peaks are the same sort of locations. So we're saying that this market is salient, it's happening across the field. And so whatever it is happening in the market is supported by the other indices. So that's how we look at the markets. When we're trading in the stock market, we're looking for strengths fundamentally, so we can trade off weaker trends, and we look at the market so that things look all right. The other aspects of trading in shares is insider buying. This is something which has some reputation. It is a worthwhile thing. You can subscribe to newsletters that point out to insiders buying out their own company because they suspect that they know some things that you don't. But you do have to watch certain things in it. Insider, well, the first insiders are defined as officers, directors and 10% shareholders on the basis that they all know something about what's going on inside the company, which is, we can say, is that they have material non-public information. They must have. They know what's going on day to day, whereas the public only knows on a quarterly basis. So it's, therefore they know more about the company, and they're defined as insiders. They know things like the current sales, like what the company sales were like in the last report. They know things like if they got any problems, if there's something is not working, then the production is going to cease soon, or whether they have successes or whether they have an inclination to know about their competitors having problems or successes. They also know if there are any issues about the key personnel inside the company, anything that the public wouldn't necessarily know. They also know if they're going to release some new exciting product they're working on, or going to release in 3 months. We wouldn't know, but they would normally know. But the question is the legality of using that insider information to trade and to profit when other people aren't able to. Well, you can't stop them buying shares in their own company, and you can't stop them knowing how the company is running because they're the officers, the directors, the people who know all these things. But insider trading is the thing that is not considered ethical. The difference between insider buying and insider trading is that you're buying shares on the basis of your inside knowledge only. Insider buying is that you see what everyone sees, but you have a little bit of extra knowledge that the figures are going to come out higher, but you would buy anyway because it's a good company. So it's a fine line, but insider trading is when you buy shares you wouldn't have bought only on the basis of what you know about the company, but because of what you heard about the company on the stairs, and then gone and bought shares, and that's insider trading, and that's the thick of it. And of course, when you do insider buying, there are certain filing requirements, and it depends on what you're going to do. But mostly we find that the insiders are filing on the internet the same day they're going to do the buying. But there are time constraints they have to comply with, so therefore the public knowledge of who's buying stuff. A word of caution, it's not all good. Just because an insider is buying does not mean that the price is going to go up. Not necessarily. What you have to do is that the company you might have been interested in anyway. You also need to check how much money the insider is buying. If his trading buying was worth $20,000, that's nothing. If he's throwing $100,000 or $500,000 or $1 million or $1 billion in shares, and then it counts as something. No one's going to be putting money in their company of that size if they didn't think they're going to profit. But not all insider buying is great. The other thing you can do is go inside the records of insider buying and see how the same people did they manage to buy at the low point when the shares were just after they bought it the last time they did the insider buying. So while they may think they're buying at a good time, see what their track record is. And the other thing is, how many people are buying. If it's just one person, say the chairman, buying, fine. But if you've got, say, the senior vice president who may not have as much money but is still buying $200,000 worth of shares along with the chairman, well, there's a general drift that this company would be going up or doing better. So it's worth watching. You can get there. If you go to yahoo.com and go to finance, you can then find out the insider figures, and I'm sure there are other sites that you can go to see what they are. A word of caution on insider buying. Is the insider buying looking for shares to go up in value? Don't get confused by insider selling. Insider selling can happen for a variety of reasons. For example, if the chairman wants to buy himself another house, or wants a vacation, or someone's college fees are due, people can sell for all sorts of reasons, and they're not necessarily selling at a good time for them. It won't necessarily mean that the prices are going down, but if they're buying from choice. They're doing something with their money as opposed to doing something else to it, so it means that usually they think that the price is going to go up. That's the end of Module 13, Stock Market. The next module, Module 14, we'll be talking about futures and the different things that you have to know to trade in futures and apply technical analysis to them. I look forward to talking to you in the next module, Module 14, on futures. Bye for now.